market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, two major stories to finish the trading week. President Trump calling for a series of potential measures to crack down on immigration. More on that in just a moment. But first, trading of futures and options on the Chicago Mercantile Exchange has been halted for several hours due to a data center glitch, disrupting trades across foreign exchange, bonds, equities, and commodities trading. Now, President Trump, the other big story, saying he will, quote, permanently pause migration from third world countries. In a lengthy post on Truth Social, he said anyone who's not a net asset to the United States would actually be removed. Now, it follows the death of a National Guard member, Sarah Beckstrom, who was shot near the White House by a suspected Afghan national. A second guard who was also shot remains in critical condition. Well, Bloomberg's Alexander Pearson joins us now. Alex, what do we actually know about the specifics here, and how quickly can this be implemented?
Good morning. At this stage, we don't actually know that much beyond what was announced in that Truth Social post a couple of hours ago. As you mentioned, the headline there was that migration from so-called third world countries will be permanently paused, as President Trump put it. And then beyond that, also, there were a series of other policies he announced that were also quite vague in terms of how they could be implemented. But those included stopping federal benefits for foreigners in the U.S., deporting foreigners who are, deemed not to be a net asset to the U.S., and also quite an extreme measure, the president saying that he would potentially strip permanent residency or citizenship from naturalized U.S. citizens who were deemed to be not in line with the administration's policies. So in terms of implementation, it's unclear how quickly he can move on some of this. On the ban on third world countries, as he put it, he could move quite quickly on that. He's done similar measures before in the past, and the courts have given him that authority. In terms of the other policies, it's a bit unclear. He doesn't really have the authority to do a lot of what he said. He can't just strip citizenship in that way, and so he'd likely need congressional approval to actually amend some of these laws to allow him to have that authority.
So, Alex, how does this broadly affect the labor market in the U.S.?
That's also unclear at the moment because we don't really have the scope, but because we don't even know actually which countries he deems quote-unquote third world. Once he lists that, we would get a better idea in terms of the flows that would be affected, what kind of workers would be affected. But it's reasonable to presume that if he means developing countries by this term, that there would be fewer workers, lower skilled workers entering the U.S., and that could certainly affect certain sectors in the U.S. That are dependent on that kind of migrant labor. Examples are agriculture, construction, hospitality, and those sectors have already been quite hit hard by other policies that the Trump administration has implemented. There have been labor shortages there, and so this kind of policy could exacerbate those labor shortages and even cause certain price increases that we've seen in those sectors that have been higher than the national average.
Thank you so much, Alexander Pearson, there with the very latest, of course, on what Trump has said in the last 48 hours. Now, for a wider look at the markets, including the CME's outage, Manish Kabra, multi-asset strategist and head of U.S. equity strategy at Société Générale Corporate and Investment Banking, joins me with Bloomberg's John Stepek, author of our newsletter, Money Distilled. John hasn't slept in 3 days because of the budget. There's just been a lot. You had the podcast, you had the newsletter, and we're still trying to digest the 88 points of the Chancellor. No, you're actually, you don't look that tired. Manish, first of all, I mean, look, there's an outage, right? So again, when you look at futures, I don't know, it's just disruptive, and so it makes everyone's life complicated until we really get to the bottom of what happened at the Chicago, Mercantile, and when we're back online.
Yeah. As in how to read this, I think it's another one of those places where we have seen, tech is the most important. One has to be, absolutely crucially, be invested fully into this. So I think it's one of those another signs. Tech is literally core part of assets, core part of our lives today.
What's your take overall, Manish, on what happens to equities from here? Again, they've had a good run, and then every 5-6 days there's worries about AI valuations, and so it feels like the sky's about to fall, but it never does.
Yeah. As in, I think our take is bullish. We have been bullish just for the sake if the year is turning, should we change? No, I think the cocktail of events that we have in America is still very solid. We got Fed unfinished business of rate cuts. We got the change in Fed leadership. We have, and what should I say, profit margins expanding beyond tech. We have one big beautiful bill coming out and the front-loaded basis. You just combine a lot of these elements. I find tech is the only sector which is actually ready to take some leverage, and market's going to give benefit of doubt to them. So we quite like hyperscalers. We like US hyperscalers.
What's your take on the markets overall, John? I mean, you couldn't make a big difference between what's happening in the UK as we're still trying to digest the budget and everything else rallied by AI and the Fed.
Well, I think it's interesting because, I mean, one thing, I was checking figures before I came on this morning. So far this year, as a UK sterling investor, you have been better off in literally anywhere else but the US stock market this year in terms of returns. And I think that's actually a very positive development. You've still got the S&P going up. You still have, whether AI is a bubble or not, it's intact, whatever's happening there. But at the same time, you've got this kind of spillover to other global markets, which are finally catching up after years of being undervalued relative to the US market. And again, it's hard to argue that's anything but positive. And obviously the US, we had a wobble partly over AI, but also because I actually think, I don't know about you, Manish, but I think an awful lot of this is about actually where they think the Fed's going to go next. And the recent bounce this week has clearly been because the Williams New York Fed guy came out and said, well, actually, no, I think we should cut in December. And as long as that's the general tone, then yeah, and I mean, you get a Santa rally, what is it, 18 out of the last 24 years? Probably going to happen again. So,
certainly if the Fed cuts in December, that's going to be a welcome boost to equities. Do you think the Fed cuts?
We think Fed cuts. We think they cut in December, they cut in April. It's absolutely unfinished business on the rate cuts. The two big macro events that we are watching, one, for sure, there's midterm elections, and then you have the Fed, change in leadership in the Fed. And I think this particular event, change in leadership, will get way more focus for currencies, for equities, for the rates, whether terminal rates needs to be shifted, lower than where it is today. I think all of that comes into a big question mark.
But Manish, how much of this is already priced in? I mean, you have a president that has certainly not minced his words on what he wanted the Fed to do.
Yeah.
And so there's a general assumption that actually the next person will just be more understanding of the president's needs.
I think we took one very out of consensus call, which is to sell inflation protection next year. Right. And that's based on the thinking, if you have a president who's fully focused on affordability as one of the key factors, food prices, utility bills, energy prices, all the policy uncertainty we had on trade this year, which has reduced to a large degree, which actually accelerates on the reduction side. So I think we're going to get impetus, which is a set of, what comes out of Washington is going to help the Fed and the leadership change there.
And there's no question, John, right, that whatever happens in the U.S. has an impact also on Europe.
Oh, yeah, definitely. I mean, you can't help but avoid it. And that's, I mean, it's sort of frustrating when you are looking at markets outside the US. Obviously, I've been talking about how the UK has been cheap for a long time, and it has come back a lot this year. But one question people always bring up is, but if the AI bubble bursts in kind of the US, what's going to happen to global equities? And, you have to accept that, they'll go down too if something does go wrong in the US. But assuming that the US does keep going up, and assuming... I take your point about Trump pushing back against inflation in terms of the kind of CPI rate, but I think it's also fair to say that if you get a more dovish Fed, the kind of overarching outlook for inflation becomes a little bit, like monetary inflation. For example, I think we will probably still see a solid bid for gold if we get a kind of dovish sort of like Fed head. But as long as that's a sort of easier monetary policy is on the cards, then I suspect that will just spill out to global assets.
And just to add to this point, as in how we look at the UK, and I think UK is very interesting at this point, for the reason it has no tech stocks, right? As in it's the only one major index with no tech stocks. So anyone looking for beyond, hang on, I got enough tech, what do I look for if tech is spending in the old economy? you buy the old economy index, which comes out to be FTSE 100. So we quite like that.
Manish, I mean, a quick question on immigration. Like, again, there was a long message by Donald Trump on how he's cracking down. That must hurt equities in the U.S. longer term, if there's not enough labor in there, and prices will go up.
As in what we are concerned the most and what we find the concern that's a lot is the youth unemployment. And youth unemployment has jumped 80%, just in last 18 months. So, whether it's AI, whether it's lack of small businesses feeling better, I think some of the Fed members have been very clear. You want to help small companies, you want to help young people, you want to help the housing market. It's those part of markets which needs a rate cut. So, as in youth unemployment, big issue.
Yeah, I mean, in terms of inflation, so I loved your Money Distilled newsletter yesterday because actually you're one of the few that see some of the bright side of what the Chancellor put in place.
Well, I mean,
what's the optimistic view?
I don't know if it's me that's seeing the upside, but yeah, no, it was interesting because I was looking at, got a piece from Anatol Kaletsky at Gavkal, and his point, which I think is actually a reasonable one, is that because the UK budget is actually so backloaded, so she's spending now, but she's pretending that she's going to get the money back in a few years' time. You've actually got quite a fiscally kind of loose world that we're going into in 2026. And therefore, from a kind of backdrop point of view, that's actually basically kind of bullish for the UK economy and for UK markets. Now, that doesn't necessarily mean the budget was any good because it didn't address any of Britain's structural issues. It made our incredibly complicated tax regime even more complicated. And it certainly didn't put us onto the road to fixing the fiscal problems because, as I said, it's all been backloaded. She's just done what every Chancellor's done for the last X number of years, which is say, OK, I'm going to fix this, but I'm not going to fix it today. But in that case, that means more spending next year.
John, I mean, is there a worry that actually doesn't lead to growth? And actually, if you look at the latest YouGov polls, it's also not popular with voters.
That is a serious issue, actually, because, I mean, the main constraints in the government are, if anything, political just now, the UK government. I mean, it's quite something to win a landslide and then not be able to do anything. But that is the situation that the government's in. And at the moment, they've got... the Prime Minister and the Chancellor are not popular. I don't think that's controversial. That's pretty obvious from the polls. They're also not popular within their own party, or certainly there's lots of people who would rather have others in there. And so they're sort of clinging on to their jobs. And at the same time, they're having to cling on to their jobs. And that means they can't get anything done. And the risk is that the budget falls apart on that basis. So, I mean, there's sort of one key area I can see right now that's the problem is the Employment Rights Act. So Labour's been very keen to push through, when you hire someone, they immediately get all the rights that you would get after 2 years now. And they've just bumped that back to, they were going to do it on the first day, but now they're going to do it for 6 months. So you still get 6 months where you can basically fire someone for no cause. And obviously that's sensible, because as we all know, if you've recruited anyone, it's extremely hard to know if they're any good until they've been in the job for at least a couple of weeks. But their backbenchers are not going to like that. So I think that's a kind of key potential flare-up issue that could derail everything else.
OK, thank you both. We went through U.S. equities, the budget, we've done it all in 15 minutes. Manish Kabra, multi-asset strategist and head of U.S. equity strategy at Societe Generale Corporate and Investment Banking, and of course our very own John Stepek of Money Distilled. Coming up in the week that President Trump said there would be tremendous progress towards peace in Ukraine. We'll assess the state of play with Amundi's head of geopolitics. That's next, and this is Bloomberg. Welcome back, everyone. Now, the Hungarian Prime Minister Viktor Orban will meet President Vladimir Putin as Russia weighs the sale of sanctioned refineries. Orban said Russia's war in Ukraine would also be discussed. Well, let's get more now with Zoltan Simon, Bloomberg's Budapest bureau chief and Eastern Europe editor. Zoltan, thank you for joining us. So what more do we actually know about Orban's visit to meet Putin?
Right. So Prime Minister Viktor Orban is on his way to Moscow. and he's expected to discuss Russian oil and energy flows to Hungary. Orban secured a U.S. exemption from under sanctions on Russian oil. But I think we're also expecting him to discuss potentially opportunities for Hungary, since sanctions, U.S. sanctions, are effectively strangling some of the refineries that are Russian-owned in Eastern Europe. And Orban was in Serbia yesterday, where he said that he would be, quote, happy to take over Niš, which is a Gazprom-owned refinery there. He's likely to discuss that with Putin today.
So Putin also says that Trump's proposals for ending the war in Ukraine could be the basis for future agreements. What more did he say, and what more do we know about it?
Well, what he also said, and what's important to remember, is that it's not a final draft, right? So probably it's all going to be in the details again. We know that the U.S. presidential negotiator envoy, Steve Witkoff, is heading to Russia next week, and we'll see what comes of it. Obviously, Orban is also going to be in Moscow to say that this is what he's been calling all along, for sides to negotiate, and he's likely to propose once again that Budapest host a potential summit for these negotiations.
Zoltan, thank you so much. Zoltan Simon there in Budapest. Now let's get some more analysis with Anna Rosenberg, head of geopolitics at Amundi Asset Management. Thank you, Anna, for joining us. It does feel like there's, some weeks where it feels like centuries, and it just goes really fast because I still haven't 100% understood, if I'm honest, what Donald Trump wants from Ukraine and Vladimir Putin.
I think you're not alone in this. We've seen flip-flopping in terms of Trump's position, right? On the one hand, there is this desire to come to a peace deal and to distance Russia and China and to get this out of the way. And on the other hand, there are U.S. strategic interests which dictate that Russia remains an enemy and you have to support your allies. And we have seen this flip-flopping throughout. And now again, the pendulum has swung in one direction. He would like this to end. But the implications of it ending on the current terms are not good for the U.S. And that's the conflict that he's constantly under.
How do you think, this is impossible to know, but how do you think, this ends?
Our base case is that this war still is going to continue for a little longer. There clearly is momentum now in the negotiations. We have a lot of back and forth this week. We have Witkoff in Russia next week. However, when you compare both proposals, the 2008 peace plan that was put forward by the US and Russia, who knows, and the European response, and you look for overlap, there are certain areas where compromise is possible. But when you boil it down, the sticking points remain security guarantees and what Putin actually wants. Time is still on Putin's side. He has no reason to really find compromise yet. He's not weak yet. He still can go further. So at this point, there's mainly an opportunity cost on losing out on potential business deals, but this was never about business opportunities for Putin. It was always about geopolitics and making, the Russia bigger, and he still can go further.
And what do we know about this corruption scandal? Actually, in Ukraine, it feels big, and it also, I believe, leads to question marks from allies that may think, who exactly are we backing?
Look, this is a war. Wars are never clean. There's always, if you look at history, wars are moments in time when individuals try to amass huge amounts of wealth, right? You've seen this in the Soviet Union, when there's transitions of power. You've seen this throughout British colonial history. So I'm not surprised that there's corruption scandals going on. It is part of the mess that war is. It makes Zelensky look weaker. It erodes the moral high ground, and that is a challenge, and it increases the need for him to compromise. So it makes him weaker. But overall, it's the reality of war as well, and we have to be realistic about that.
What do we know about the frozen assets that many European countries, the frozen Russian assets that they want to use to help Ukraine?
So there are some that think that now that it was part of the 28th point plan, basically saying that the US and Russia are going to divide them up amongst themselves in a simplified way, that as a result you cannot go back to the debate of Europeans using the frozen assets as a collateral for helping Ukraine. I think that's incorrect. It doesn't mean that. eventually, if the Europeans are forced between a really bad outcome or using that to continue to fund Ukraine militarily, they're going to back it up. And as we speak, there are many creative ways that they're currently coming up and trying to get hold of some of these assets, of finding some kind of extra funding for Ukraine, because ultimately it's still the cheapest way of guaranteeing European security. And we have had many episodes in the past where, in the light of crisis, the Europeans get together and find a resolution, and I would expect this to be the case here too.
And so one of the biggest stories also overnight is the fact that Donald Trump is demanding this reverse migration, right? A sweeping crackdown on immigration in the U.S. And with the team this morning, we were discussing whether this is geopolitics or whether this is domestic affairs to prop up voters and what it does to the labor market. How do you see it?
Well, in the first instance, it is domestic affairs. But what we see is a lot of the policies that the Trump administration has been pushing through are eroding the superpower status of the U.S. One of the key advantages that the U.S. has over China, for example, is attractive demographics. It has younger population. And if you kick out a lot of immigrants that generally are on the younger side, you erode your attractive demographics. And as a result, that doesn't help the U.S. on the big stage either. And again, it creates more distrust with allies, with other countries, and more uncertainty about what the U.S. is still doing.
I mean, does it have implications, for example, for the greatest technological war, which is U.S.-China?
Well, I mean, this still remains to be seen. It depends on how much the U.S. can continue to attract talent. And that is something we have to look at the detail. I would imagine that that's not necessarily a main impact. But again, we have to await the details of what this really means. Is he going to follow through, or is it one of those things that has been thrown out there?
I mean, it's been now 11 months, actually, since Donald Trump has been in charge. Is there an overarching theme that makes sense to you in terms of foreign policy? We kind of know what he wants for the economy, but what does he know, or what does he want the U.S.'s part in the world to be?
So I think the overarching theme for him is increasing U.S. power, but the result is the opposite. We have really transitioned very fast from unipolarity to multipolarity this year, and we're seeing this with how bold Modi, Putin, Xi have come up onto this world. He thinks that business deals are how you conduct foreign policy, but this is not the case. So the idea is increase U.S. power. The result is the opposite, and as a result, we're moving to a much riskier multipolarity. I think there's one key differentiation as well in Latin America, where he's really trying to expand U.S. reach, and that is a game changer compared to previous decades. But all in all, the conclusion is a much messier, riskier world where there's a lot more division and rearming and arms race and technology race.
Who wins in this?
I think middle powers that can, leverage each other. But the big question will depend on how the tech race is ultimately going to play out. We don't know that yet.
Anna, thank you so much, as always, for joining us. Anna Rosenberg, Head of Geopolitics at Amundi Asset Management. Coming up, we'll also talk banking and banking M&A, the use of AI to generate investment returns, and the future of Switzerland as a financial hub with the EFG Chief Executive, Giorgio Pradelli. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. European traders coming in after the Thanksgiving holiday have been wrong-footed by a technical issue at the Chicago Mercantile Exchange, halting the trade of futures and option contracts. Well, President Trump calls for a series of potential measures to crack down on immigration following an attack on 2 National Guard members in Washington by an Afghan national. And the Hungarian president is meeting Putin in Moscow to discuss energy supplies and Trump's plan to end the war in Ukraine. So as deal-making picks up in the banking industry, one bank keen to get involved in the acquisition spree is a Swiss private bank, EFG International. Now, the Zurich-based bank made 2 acquisitions this year and hopes for more of the same in 2026. Well, joining us now is Giorgio Pradelli, Chief Executive of EFG. Thank you, Mr. Pradelli, for joining us. So what specific businesses or geographies are you targeting, and how hungry are you for an M&A deal?
Well, it's good to talk about M&A on a Black Friday. Unfortunately, in banking and in M&A, we don't have this kind of days where you can get this kind of discount. No. Look, we are looking for acquisitions in the locations where we are present. Clearly, we are present in the major financial centers across the world, from Switzerland to London, to Luxembourg, to Hong Kong and Singapore, to Miami. So as long as we are present, we would like, obviously, to add some talents and capabilities, and the focus will continue to be that.
Are valuations looking expensive in your world, or actually can you find something reasonable?
Well, look, this is a very good point. I think valuations obviously are important, and generating a return on investment out of the acquisition is very important. But for us, what is critical and actually is our number one criterion for doing acquisitions is actually the cultural fit. And we need the last 2 acquisitions that you mentioned earlier, actually were like partners coming together. We are probably the best growth story in private banking in the last 5 years. And so people like to join us. And this is what we are trying to. We are trying to find partner, to add talent, and to, have a win-win situations.
Giorgio, you have some new targets. I think your return on tangible equity has been upgraded 20%. That's very ambitious. Do you worry about different cycles and the fact that you have to remain in that no matter what the economy throws at you?
Well, that's a very key point. We have been trying to do well over the cycle. Our strategy, I think, is a true the cycle set up and business model. We have done well over the last 7 years. We started this strategy of sustainable and profitable growth in 2019, and as you can see, there have been very cycle. We are already in excess of 18% return on tangible equity. Clearly, we need to maintain and grow further, but we believe that the targets are ambitious yet realistic.
Talk to me about AI. Yeah. So a lot of the financial industry is trying to integrate it. I know a lot of family offices believe that actually can change their outlook, or it can change the way that things are done. How much focus are you thinking of AI, and what does that mean for the bank?
Look, AI is going to, I believe, change financial services, like technology has changed financial services in the 80s and the 90s. Now we are we are doing the first steps to be fair, but we have introduced in our strategy for the next 3 years the concept of the augmented client relationship officers. Mm-hmm. Our clients will still want to have a person, an expert dealing with them, but the integration of one relationship manager with the teams of experts and with tools that will be all powered by AI, this is extremely powerful.
But this is what, 20% extra productivity? Does it cut cost, or is it difficult to
Well,
say
I think it's difficult to quantify. I couldn't quantify at the moment, but I think it's going to be more than only productivity and cutting costs. I think it's going to be also huge in terms of improving the client experience, and this is one of our targets for the next 3 years, to improve our brand profile and to improve the client experience going forward.
How much do you worry about Switzerland as a financial hub? I know there's a lot of worries, for example, about London as a financial hub, and Switzerland is going through, U.S. tariffs, more regulation, competition from Dubai, Hong Kong, and Singapore, and at the same time, there's also this higher capital requirements for banks.
Well, look, I've been bullish about the Swiss financial centers also in years when many people were even more, let's say, pessimistic than today, and also, by the way, very bullish about London as a financial centers. And actually, I always talk that we have a 2-pillar strategy, because our headquarter is in Switzerland, but also we have a lot of activities done. For example, our Chief Investment Officer is here based in London. Our teams in asset management are here based in London. No, look, I believe that in our business, wealth management and private banking, Switzerland will remain the number one location worldwide. Clearly, there is a lot of competition. There are many other financial centers that are trying, obviously, to emerge. But it's a bit, since we're in London, it's a bit like tennis. right? I think Wimbledon is still the #1 tournament. I think Switzerland will remain the #1 location. Now that the other locations are trying to emerge, I think that's also not bad. I believe in competition, makes you better every day.
Okay, so a little bit of healthy competition has never hurt anyone. When you look at strong Swiss franc, again, how much of that is an issue for your profitability?
Well, look, that's a very good point. We have, as EFG, now I'm talking about EFG, we have about shy of 50% of our assets under management in US dollars.
Okay.
So I look the other way around. Obviously, we have seen a weakness of the US dollar in this calendar year. And clearly that has an impact. But, on the other hand, I've seen also, looking at Switzerland again, if you look at all the export industries, they have had a strong Swiss francs for decades. And the result is that they have improved their efficiency, productivity. Now, again, do I like it? Not really. But, we need to navigate the environment as we find it. I think 2026, maybe there are some headwinds, but for the medium term, the prospects are very good.
So there's not necessarily a natural hedge?
No, I mean, there are financial hedge. Actually, we were hedged this year. Yeah. There is a hedge for everything. We were actually hedged this year, which is good. Now we need to see, as I said, 2026. And but yeah, we need to navigate the environment.
Your take on private markets? I'm throwing everything at all the big issues. I'm throwing everything at you.
No, look, I believe that private markets are very important. Our clients like private markets. Actually, as a firm, we would like to do more in private markets. Obviously, again, some people some years ago believed that private markets don't go through cycles. I think that's not right. Obviously, they also go through cycles. Maybe the cycles are a bit softened because you don't have the mark-to-market every day. But no, we are positive on private markets, and again, they have a key role in the asset allocation for our clients.
What kind of private markets? Again, no private markets.
Private equity, private credit.
No.
Yeah. Real estate. Our clients love real estate and infrastructure. I would say these are the key areas where our clients look.
Giorgio, is there anything that worries you about the markets right now? Again, there's AI valuation. There's just a lot, to be honest, to contend with. There's tariffs. There's geopolitics.
Well, when people tell me don't worry, I always say I'm paid to worry. So I worry about everything all the time. Now, I would say that the last couple of years there has been a lot of uncertainty and volatility, yet the market were constructive. We have not seen a major correction. Yes, I'm obviously concerned that something could go wrong and something that we have not foreseen is going to come in. Clearly, I'm looking at the bond market. I'm looking obviously at the valuations in the equity markets. I'm looking at the bond markets. The level of debt in the developed economies is the highest in a period of peace. So clearly, this is also an issue. I was on a trading floor in 1994 when the long bond went from 6% to 8%, and we had an havoc in the markets. So obviously we worry about many things, and as I always say, and as I said on Tuesday during our Investors Day, we try to navigate at best the markets and try to anticipate the trends. But for our business, the long-term trends are actually very positive because I believe in two things. I believe, number one, that entrepreneurs will continue to generate wealth, and at the end of the day, wealth management and private banking is about managing the wealth created. And second, this wealth, given also about geopolitics, private banking is geopolitical risk diversification. Wealth will move to, let's say, calmer harbors, and I believe that a lot of financial centers that we mentioned are, let's say, more of a harbor shelter for some of these entrepreneurs.
Inheritance tax. So people in Switzerland, voters in Switzerland, will vote on inheritance tax, I believe, this weekend. What does it mean for your clients?
Well, this has been obviously a topic that has been debated. It's obvious that if something like that would happen, wouldn't be good for the way that the country attract wealthy individuals. Now, the polls at the moment say that this will be rejected. We will see. But I don't think that this will change the prospects long term.
Okay. Thank you so much for joining us. We went around the world there in like
Thank you very
10
much.
minutes. Giorgio Pradelli, the Chief Executive Officer of the Swiss private bank EFG International. Now, let's also talk about commodities and oil, headed for the longest run of monthly losses in more than 2 years as traders look ahead to an OPEC Plus meeting on Sunday. Brent on course for a fourth straight monthly drop in November amid concerns of a global glut. This comes as trading of futures and options on the CME stopped for several hours. Now, let's get more from Will Kennedy, Bloomberg's EMEA News Desk editor. Will, it's nice to have you back talking oil. So what's the extent of the impact of this CME outage?
Very nice to be with you, Francine. Yes, it's quite a significant part of the financial markets that are affected here. Trade in WTI, the main US oil benchmark, of course, is not working, but also trade in lots of other futures markets, including S&P futures, Treasury futures, gold futures, US copper futures. So it really is affecting a lot of derivative markets, a lot of commodities markets, and this would be a day where we wouldn't have much liquidity, being the day between Thanksgiving and the weekend. But nonetheless, the longer it goes on, the more tricky it will be for traders who are looking to take positions in these markets.
I mean, of course, investors watching very closely what happens in Ukraine. How much does that impact actually the oil market?
It's a really interesting question, Francine. In some senses, we've noted over the past few years that the sanctions on Russia, the actions that the West has taken against Russia, have not actually impeded the flow of oil into the global market. That has tended to remain strong through use of the shadow fleet and tactics like that. However, I think there's no doubt in terms of sentiment, a peace deal, especially a peace deal that came with significant sanctions relief, which was part of the US proposal initially, would be bearish for markets. At the margin, it probably would mean more Russian oil could get into the market and would just remove some of the friction from global oil markets. So I think they would put a bearish interpretation on that, and that would come to a market which is already well supplied and looks increasingly well supplied going into 2026.
Well, what are we expecting from OPEC Plus?
Well, because of the outlook, the relative imbalance we see in the market, the bearish balances, OPEC, after increasing production to get back market share through much of 2025, signalled at its last meeting a month ago that it would pause production increases next year and hold things steady. And we don't think there's any reason to think that that would change. Talking to traders and analysts who follow OPEC, their expectation is very much that that policy will remain in hold and that OPEC will have to hold production. I think the question increasingly will be, as we go through next year, is there a point that OPEC feels that it has to cut production again because the market looks so oversupplied?
Will, thank you so much. As ever, Bloomberg's EMEA News Desk editor, Will Kennedy. Now, China's top diplomat has used a call with his French counterpart to say the two sides needed to support each other, underscoring Beijing's push to win diplomatic backing during a spat with Japan. Well, Wang Yi said Japanese Prime Minister Sanai Takaishi had made provocative remarks related to Taiwan this month. The French President Emmanuel Macron is due to attend a state visit to China next week. Now, officials say Hong Kong's deadliest fire in nearly 8 decades has killed at least 128 people. This, as they say, fresh arrests have been made in connection with the blaze. Dozens of survivors remain in hospital, with hundreds more left homeless as a criminal investigation continues into the cause of the disaster. Our China correspondent Min Min Lo has more.
I'm just standing across from the site of the fire behind me, and we just heard some sobering numbers from the latest press conference. The current death toll stands at 128. 108 of the bodies have already been taken out of the buildings, but there are still 16 bodies remaining in the buildings right now. About half of those people died in their apartments, and there are at least 40 more bodies that are still of unconfirmed identities. And the government has said that there are about 460 cases of missing people unaccounted for, but they caution that there might be some duplicate cases as well. And a lot of attention now is on the cause of the fire. The authorities explained that the netting around the building had caught fire first, but the styrofoam boards helped to spread the fire quickly. And under the intense heat, the bamboo scaffolding had fallen apart, and that helped to spread the fire to other buildings as well. They also investigated the fire alarms, which were not working in any of the buildings, and the authorities said that they will be arresting the relevant people. It's just been an incredibly heartbreaking, not to mention very disappointing thing to hear for the residents here. But over here you can see this is entirely volunteer organized that sprung up organically overnight. Here you can see clothes that are given out, and there are even pet food over there behind me. And right here you can see, of course, clothes. There are beddings, blankets, tents, shampoos, disposable underwear, everything you can think of that could help you sleep for a night comfortably. And just over there inside the mall, I found people who slept overnight indoors just in the corridors of the mall. And it's, you know, they're all in a daze. I was asking them what are their plans for the coming days, and one man told me he hopes to be able to return home tonight, but that just seems like an unrealistic expectation for now. Min Min Lo, Bloomberg News, Hong Kong.
And of course, we'll keep you updated on the situation in Hong Kong as news comes in. This is Bloomberg. Welcome back, everyone. Now, the fashion retailer Zara may have been one of the pioneers of fast fashion, but with China's Shein and Temu undercutting that market, Zara is now looking to pivot into the high fashion segment. That's the subject of today's Big Take, which also coincides with the retail bonanza that is Black Friday. With us now, Bloomberg opinion columnist Andrea Felsted and Ashley Wallace, head of European consumer goods research at Bank of America. I mean, there are so many questions about what we're buying, what people want in the U.S. compared to Europe. But Andrea, first of all, if we just focus on Zara a little bit, like what are the segments that work? And with the arrival of Temu and Shein, does Zara have any choice to go slightly upmarket?
No, I think they have been going upmarket for, I'd say, the last couple of years. And that is the right thing to do because the luxury segment has raised prices so much, it has priced many people out, especially the aspirational consumer. So there's a lot of white space for other brands to go for. We've seen that with Coach in bags, with people like Suzanne in clothing. And Zara has a real opportunity to go more upmarket and capture some of those sales that would have gone to the luxury brands.
Overall, I mean, what works without talking, about Zara specifically? Are we buying clothes? Are we buying beauty? And is there a price point that's like the good spot where everybody wants to be in?
Well, actually, quite interestingly, in context to Zara, I think one of the opportunities that they've been able to see over the last couple of years is the fact that we've gone through a world where the dominant fashion aesthetic is called quiet luxury. And so we're in a world where the logo is less present, where it's more about the quality of the material. And that means that from a consumer perspective, you can be in fashion at any price point. So you can spend thousands of dollars for Loro Piana, Brunello Cucinelli, cashmere jumper, but you can also be as in fashion by shopping price points all the way down to Zara for a very similar, at least from an aesthetic perspective, product overall. So I do think that the fashion element of quiet luxury has probably been quite helpful for players like Zara.
And I mean, are people buying like high-low? So is it pieces from Shein and then Louis Vuitton, or is it Zara and Suzanne?
I think there is high-low. I think Zara is still, despite the best efforts, I think it is more low, where you mix pieces from Zara with more upmarket pieces. You maybe still buy the bag, but you buy all the shoes, but you buy the clothes in Zara. So I think, yes, they are definitely benefiting from that high-low approach.
Actually, where are people spending? I know you had the Bank of America, Paris conference. Mm-hmm. So what did you learn? Are people, again, travel also comes into this as more people travel in luxury, mm-hmm. or maybe we'll book, we'll travel with EasyJet, but then book a really nice hotel. Mm-hmm. So when you look at discretionary spending, how has that changed over the last 2 to 3 years?
Yeah, so in terms of discretionary spending overall, what we are seeing is the consumer shop more and more around these important shopping holidays. So a bigger share of wallet is shifting to Black Friday, to Double 11 in China, to Christmas, and this is where we're seeing demand pick back up, but it's the period in between that becomes a little bit tougher for the consumer overall. In the conference last week, we learned a little bit about Double 11, which has just finished in China, and what we saw there was the beauty category actually do quite well, so with net sales for beauty being up somewhere between high single digit and low double digit, international brands regaining some lost share from the local players, luxury, so premium beauty outperforming mass, so things to kind of point to a more healthy backdrop for consumption across the beauty category in China going into 2026. As we think about Black Friday, which is obviously a very important shopping holiday, especially in the US, I think that there's reasons to be optimistic around what will happen this year. Part of what we've seen in Q4 so far is actually a sequential acceleration in consumption across the luxury category, and that's true for handbags and soft luxury, but also for jewelry, actually being particularly strong. Whilst neither of these categories are necessarily categories you can buy on discount during Black Friday. Again, cosmetics is a very important component of the Black Friday week. So actually this week coming up is 12% of Q4 revenues for beauty companies. So a big proportion of what will happen for the rest of the year is basically determined this week. For luxury, it's a little bit different, actually. What we see in terms of purchase behavior is there's a lot more spend that happens in the weeks leading up to Christmas, which become more material.
And we've talked about this in the past, Andrea, that a lot of these, really high-end luxury, they've just put up the prices too much, and at some point it really bit them. Or we see, they can't really reverse. You can't buy a Chanel bag for $10,000 one day and then they put it down to $8,000. But can they do anything to mitigate that, to accelerate demand?
What they've been trying to do is to move into more accessible categories. So we've seen beauties very popular with the luxury brands. We've seen small leather goods return. We've got those mini bags that everyone's carrying, bag charms, jewellery. You think of jewellery as you think of jewellery as very high end, but it actually has, one of the reasons it's done well is it hasn't had the price increases that the luxury brands have had, and some brands have even, they're introducing jewellery, but also smaller watches which you can charge less for. So there are all these ways to try and reclaim that aspirational customer.
Actually, how's e-commerce doing? I know in the US it's probably doing better than in stores, or is it like 50-50?
No, this year actually what we've seen through the year is actually e-commerce start to regain some of the momentum that it had lost the last couple of years, and this is also true in the luxury area as well, that there's outperformance of e-commerce again after 2 years of underperformance, and that's quite important because it means that you can address a much wider customer base. And coming back to the point around pricing, actually what we're seeing a lot of the luxury brands do is introduce newness at lower price points. So mix is actually negative, despite the fact that pricing has moved up a lot. That's a way to address the volume issue that exists in the sector, and that's going to be helped next year because we have 20 brands with new creative directors. So there's a whole wave of newness also coming into stores next year, especially around soft luxury, that will help probably encourage consumers back into the stores and into luxury brands again.
So do you have to start a sister line for the lower price point, or is it just a category?
No, it's not necessarily a sister line. It's more about newness. So like a handbag that can be canvas instead of leather at $1,000 rather than $3,000, and that kind of address a different type of clientele. I actually think that some of the companies that have done the best job of this is actually jewelry. So as jewelry brands have been taking prices up, and as you've seen that price increase actually be very much supported by gold rally and raw materials or commodity prices, what we've seen actually many of the jewelry companies do, especially Cartier has been doing it fantastically well, is adding back smaller and medium variations of classic product. And that means you can price segment your clientele in a very different way, and you can still capture that customer that maybe can't afford necessarily to stretch all the way up into where your new pricing is, but allows you to satisfy the volume demand that exists in the business.
So interesting. Thank you both for joining us. Bloomberg opinion columnist Andrea Fauchten and Ashley Wallace, head of European Consumer Goods Research at Bank of America. Now, we do have a busy Friday. There's quite a lot going on. Remember, there's this computer glitch over at the CME, which means that some CME futures has been disrupting trading across global markets. If you look at stocks overall, look, Europe is flat. It's very clear that the S&P 500 was, before the outage at the CME, on course for its first monthly loss since April. Up next, Bloomberg Brief, and this is Bloomberg.